Pratt Company acquired 80% of the equity shares of same company. Pratt Company values non-controlling interest at fair value. And at the date of acquisition, goodwill was valued at $20,000. At December 2005, the goodwill was fully impaired, which means that this $20,000 became zero. And when did it become? At December 2005. You acquired on January 2005. It is full 1 year. In reviewing the fair value of Sam's net assets at acquisition, Pratt Company concluded that property, plant, and equipment with a remaining life of 5 years had a fair value of $5,000 in excess of its carrying amount. So here, in excess, so fair value is more. Sam Company has not incorporated any of these adjustments, like the goodwill and the fair value, in the individual financial statements. What is the total charge to group retained earnings at 31st December 2005 as a result of these consolidated adjustments? So when I say that total charge to group retained earnings, so actually group will take retained earnings from the subsidiary, and you have 80% ownership. So whatever there is an increase or decrease in the subsidiary retained earnings, 80% of that increase or decrease will be coming to the group. This is what you should start with. So first of all, we know that what will happen, that there is an impairment loss, which is happening like 20 million or $20,000. So that's an impairment loss. And then you say that this is, of course, 80% of that is going to impact us. Okay, 80% of this thing will come to the group. I can do it here, I can do it later on. But just to keep it simple, I can say that 20,000 into 80%, this 16,000 is actually something which is going to impact the parent. Parent group retained earning will decrease because there's an impairment loss on the subsidiary. So loss of the subsidiary, 80% you have to absorb. And then it says that fair value adjustment. Now I told you that fair value adjustment will increase the depreciation, okay? And of course, when you increase depreciation, profits, they go down. So profits decrease. Let me write down like this, and we create some space for that. So how much is the fair value adjustment? It is $5,000. But there's a life of the asset is 5 years divided with 5. And you have full 1 year period after acquisition. So you do not need to calculate any months. You can write down it straight like this, 5,000 divided by 5. So this is also an amount. And 80% of this amount will be reflected in group's financial statement. And of course, it is an increase, fair value increase, which means depreciation increase, which means profit decrease. So this is also a decrease. Both of them are going to decrease the profit of the group. So you should say that 16,800. Your answer choice should be A. The group retained earnings will be decreased by $16,800. So that was pretty simple, but of course we need to collect these bits and pieces. Let's do one more question, which is 242, which I picked up. It says that on 1st July 2005, Pull Company acquired 80% of the equity of SAT Company. At the date of acquisition, goodwill was calculated as $10,000. And the non-controlling interest. Okay, let me first read the question first. Okay, I started reading the requirement. Let's first read the requirement. What is the Pull Group profit for the year? Okay, you should pay attention that sometimes they ask you group retained earning and sometimes they ask you profit. Whenever they use the word retained earning, it means all the profit on the balance sheet ever incorporated from day one. I'm sure you understand the difference between profit for the year and retained earning. Retained earning, these are those profits which you have accumulated over a longer period of time. Retained earnings are undistributed profit. Listen, I have to speak again because I'm sure that you guys know, but I still want to speak on that. Let's suppose that in year one, when you started the business, you made $100 profit. Your profit was $100. You gave out dividends you gave out, say 40. So your retained earning is 60. Retained earning is undistributed profit. In year two, again, you made profit 100. You again gave dividends 40. So your retained earning is 60, but you have 60 from the previous. So you have now 60 plus 60, which means 120. In year three, you made profit of 100 and you gave out dividends of 20 and 80 should be added. So your retained earning becomes 200. So whenever you see retained earning balance on the balance sheet, retained earning means all the money which you have saved. I use the word saved because dividend you gave out, retained earning is like saving for the business ever since you created this company. And now, let's suppose this is 200 is the retained earning. Now, when I say what is the profit for the year, I'm talking about $20. And when I say what are the retained earnings at the end of this date, you will say 200. So profit is actually for the year. I'm sorry, profit was 100, not 20. I'm sorry, 20 was dividend. Profit was 100 for the year. And retained earning is the total amount. So sometimes they are talking about group profit. So if they ask me group profit, so from subsidiary, so subsidiary has two things. Subsidiary has retained earning on the balance sheet and subsidiary has profit on the income statement, current year profit. Profit means current year. So if I ask you, what is the group share? Now there is a group has 80%, okay? You have 80% ownership. If I ask you, what is the group retained earning? So it means I'm saying take 80% from here. But when I ask you, what is the group profit? Then you are taking 80% from here. So this is one very little difference, which you should pay attention on the language of the question. In this question, we are talking about Pull Group profit for the year. Pull Group profit includes, I've not read the question. I don't read the question. I know that Pull Group profit will include what? Pull Group profit will include parent, full profit for the year, not retained earning. I'm saying parent's profit for the year and plus, okay, let me write down, it's not making it clear. Let me put it like this. I would say, so I say, I've not read the question. We'll read the question later. First, we are trying to understand the concept. Pull group profit. I'm saying not pull profit, but pull group profit. So group profit will include parents' profit for the year. And of course, it will be full. And I would say plus parents' share in subsidiaries profit for the year. So we are not talking about retained earning. We are talking about parent share in subsidiary profit of the year. Now let's start reading the question. On 1st July 2005, Pull acquired 80% of the equity share of SAT. At the date of acquisition, goodwill was $10,000. And NCI was measured at fair value. In conducting the fair value exercise on SAT companies at asset acquisition, Pull concluded that property plant having the remaining life of 10 years had a fair value of $300,000, which means annual depreciation is $10,000 or $30,000. So SAT company had not incorporated this fair value adjustment into individual financial statement. At the reporting date on 31st December 2005, acquisition happened on 1st July 2005. So you are thinking about July, August, September, October, November, December. We talk about 6 months. The goodwill was fully impaired. The goodwill was fully impaired. So this three and whatever was the goodwill, $10,000, it is gone. For the year ended 31st December, SAT company reported a profit of 200,000. Now we are getting 80%. Okay. So generally speaking, we should be taking 80% of the profit. But the thing is that this 80% number we need to adjust. This 200,000 which they calculated, they are not including this fair value adjustment. They are not considering impairment goodwill. So all what we need to do is that we need to split. First, we need to adjust the profit, and then we need to make some adjustments on goodwill or whatever extra depreciation. Then what adjusted profit you will get, you will take your share from there. So let's see, I would say that. So how do I write down this question? I will say subsidiaries profit for the year. For the year is 200,000. But this 200,000 is for full year. I need post-acquisition profit because we do not have a right on 200,000 because 200,000 is for 1 year. We need post-acquisition period, which is just 6 months. So you should just divide this number with 2. So this is the profit where we are stakeholder. Okay, this is something which is our starting point. 200,000 is not our starting point because we came in the middle of the year. We came on July 1st. So from July to December, this is the profit we can claim something. And then you have impairment of goodwill. So how much is the impairment of goodwill? That is $10,000. So you subtract that. Okay, this is 200,000. So, and then you have extra depreciation. Extra depreciation means as a result of fair value. When you do fair value, there is extra depreciation coming. Extra depreciation means that they did not include depreciation at the fair value. They did it at the cost value, at the cost model. They charged less depreciation. I have to add more depreciation. How much is that? That is 300,000 divided with 10 because the fair value is 300,000 and the life is 10 years. But this you should also take 6 by 12 for 6 months because I'm considering a profit of 6 months. So I'm talking a depreciation of 6 months. Okay. So we take here 6 months thing. Where is our question? Okay. Where did we go? Yeah. So we'll take this 6 months thing and we should multiply it with -1 because it is going to decrease the profit. And let me put equals to sign. So now we can say this 75,000. Now what is 75,000? I call it adjusted profit of SAT company, which is your subsidiary. So first you have to adjust the profit. And then from this you have to give to someone. Now they say that what is the full group profit for the year ended? That is attributable to non-controlling interest. Not to the parent, but to the non-controlling interest. So first we calculated the profit. Now this profit we calculated. This is the number. From here we give NCI share. And of course, NCI share is 20%. And you should say that 75,000 times 20%. This is your answer, $15,000. This goes to NCI. If they ask us that how much will go to the group, so we will say group's share. Group share will be 80%, and that should be 80%. And 80% of that, they did not ask us, but this is how you should be doing. That this 75,000 should be split between the parent and the subsidiary based on their percentages. So now comes this question number 243. It is better to read the requirement first. It says, what is the cost of sales in Paprika Company's consolidated statement of profit and loss for the year ended 30th April? So we have to calculate consolidated cost of sales. Now, you know that your cost of sale, general formula for your cost of sale is always parent's cost of sale plus subsidiary cost of sale minus intragroup sales, not intragroup cost of sales, not intragroup cost of sales, pay attention, intragroup sales, and plus PUP. PUP was your unrealized profit. So this is a general, very standard basic formula in cost of sales. However, sometimes it is possible that you may have some impairment of your production equipment. So it means that production equipment value goes down. Then it should be charged to cost of sale because it is kind of extra depreciation. And because depreciation of production equipment should go to cost of sale, that could be an item which sometimes they say that take it to the cost of sales. Anyways, let's start reading the question. 243. Paprika Company purchased 75% of equity of salt on 30th April 2004. Pay attention, 30th April 2004. Non-controlling interest are measured at fair value. The cost of sales of both companies for the year ended 30th April are as follows. Cost of sales in Paprika and salt. Oh, so subsidiary, the salt has higher cost of sales. The following information is provided. Salt had machinery included in its net assets at acquisition with a carrying amount of 120, but a fair value of 200. The machinery had a remaining useful life of 8 years. So you see, this is the question. You are doing a fair value adjustment of machinery, which means you need to charge extra depreciation. And because this is a case of, production equipment, this extra depreciation is not going to go to admin expenses. Extra depreciation will be added as an expense in the cost of sales. The machinery had a remaining life of 8 years, so 120 divided by 8. All depreciation is charged to cost of sale. So this cost of sale, we should increase. We should add some extra depreciation into it. During the year, Salt sold some goods to Paprika for 32,000 at a margin of 25%. 3/4 of these goods remained in inventory at year end. So this is unrealized profit. Pretty simple question. Should not be creating problem. You should say that group cost of sales, and group cost of sales will include, Paprika, which is the parent. I'll take the full amount, 60,000. And then I would say, Salt, which is the subsidiary. And I take 100,000 here. Let me finish the question and then I will tell you a trick which you should pay attention to. There is a trick usually in such questions. I will explain that later. Then you have extra depreciation, we call it. Okay. The additional depreciation due to the fair value. How much is the fair value? Fair value increase is 80,000. Okay. Because in the books it is 120, but really it is 200. So 80,000 is the increase and you divide it with 8. So it means that 80,000 by 8, 10,000, and this is going to increase the fair value. The extra depreciation is going to increase the cost. So you add it. Then you have unrealized profit. Okay. So unrealized profit, we see that how much are the unrealized profits? Okay, we forgot one thing. I straight jumped here because I was thinking about here. You see the formula: parent cost of sale plus subsidiary cost of sale minus intragroup sales. So intragroup sales we should subtract here. I forgot that. Intragroup sales were 32,000. So this 32,000 I should be subtracting. Intragroup sales 32,000 minus. Then you have unrealized profit. So what is the good? It says that sold some goods to Paprika for 32 at a margin of 20. Now here it is a case of margin. Margin means percentage on the selling price. It is selling for 32,000. So margin means 32,000 multiplied by this whatever percentage, 25%. 3/4 of these goods they remained in inventory. 3/4. So how would I do that? I would say 32,000. This is the sales volume multiplied by what is remaining in your stock. It is 3/4, which means 3 divided by 4. So this is the value of the closing inventory. And within this closing inventory, the profit percentage is 25%. Okay. So this is how I will calculate. This is my unrealized profit. And what do you do with this unrealized profit? Do you add it or do you subtract it? Of course, you add this thing. I said plus unrealized profit. Intragroup sales are minus, unrealized profit is added, and you make a total of that. So you've got 144,000. This should be your answer. You've got here group cost of sales. Okay. Now I said that I will tell you some trick. What they can change the question. Now, if you pay attention, this question is for full 1 year because 30th April 2004 you purchased and 30th April you are going for making it, by the way. Okay, so it is for full 1 year. It's not a 6 months period. The income statement you are considering for full 1 year. If they told you that it is only a 6 months period, you should remember that balance sheet you do not proportionate. If I tell you that subsidiary assets are 1 million and probably you purchased the subsidiary 1 month ago, just 1 month ago, you will not proportionate on monthly basis. You take full assets. Balance sheet is never proportionate. It's not period of time. Income statement is period of time. If they tell us that it is a 6 months thing, you know what I would have done? This number, parent number, for example, I will take the full number because parent was there. Subsidiary, I will say 100,000 divided by 12 multiplied by 6. I take 6 months. Intragroup sales, I will take full because they told us that if the sales are post acquisition, so it doesn't matter 6 months or 3 months. They say after acquisition, parent has sold goods. So there is no need to subtract this. This total sales you will make 6 months. This you will not. And extra depreciation, again, you will take 6 months. And unrealized profit will go as it is. If it had been a 6 months thing, your answer would have been 89,000. If it had been a full a 6 months question. But our question is for 1 year. We talk about 144,000. That should be your answer.